You know how they say the average investor does worse than the market? Well, Jim Simons is the furthest thing from average. This guy, a mathematician turned hedge fund manager, consistently blew the market away with his fund, Renaissance Technologies. We're talking an average of 66% return per year after fees. That's insane. So how did he do it? Was he psychic? Did he have a time machine? Well, not exactly. In this video, we're diving deep into the 7 key strategies Jim Simons and Renaissance Technologies use to achieve these mind-blowing returns. We'll uncover the secrets behind their data-driven approach, their team of math whizzes, and their relentless pursuit of market inefficiencies. Get ready to have your mind blown because these strategies are not your typical buy and hold advice. This is next-level investing. And while we might not all be math geniuses, there are definitely some key takeaways we can all learn from. Now, before we even get into the nitty-gritty, we need to understand the foundation of Simon's success data. And not just any data, we're talking massive, mind-boggling amounts of it. Simons recognized early on that Wall Street was drowning in data, but most firms didn't know what to do with it. They were still relying on gut feelings and traditional analysis. He saw an opportunity. Instead of fearing the data deluge, he embraced it. Renaissance Technologies became obsessed with collecting and analyzing every single piece of data they could get their hands on. We're talking stock prices, trading volumes, economic indicators, you name it. If it existed, they wanted it. This data-driven approach became the bedrock of their entire investment strategy. They didn't rely on hunches or rumors, they let the data speak for itself. By identifying hidden patterns and correlations within the data, they could anticipate market movements with uncanny accuracy. This is not your grandpa's stock picking strategy. This is about using the power of data to gain an edge in the market. Okay, so they had mountains of data, but how did they make sense of it all? This is where things get really interesting. Simons brought in not just Wall Street veterans, but mathematicians, physicists, and code-breaking experts. Their mission? To build algorithms, complex mathematical formulas that could analyze the data and identify profitable trading opportunities. These weren't your typical Wall Street algorithms. These were sophisticated systems designed to find signals in the noise. These algorithms could spot patterns that were invisible to the human eye, patterns that indicated when a stock was about to go up or down. It was like having a glimpse into the future of the market. But it wasn't just about building a single algorithm and calling it a day. Renaissance Technologies was constantly testing, refining, and evolving their models. The market is a dynamic beast, and their algorithms needed to adapt to survive. This constant evolution was key to their long-term success. Here's the thing. Simons knew he couldn't do it alone. Even with all the data and algorithms in the world, he needed a team of brilliant minds to make it work. And not just any brilliant minds, he wanted people who were the best in their fields, but who also weren't afraid to challenge conventional wisdom. He assembled a team of mathematicians, physicists, signal processing experts, and even code breakers. These weren't your typical Wall Street guys in suits. These were academics and researchers who were more comfortable with equations than with Bloomberg terminals. But that was the point. Simons knew that to beat the market, he needed a team that thought differently, a team that could approach the problem from a fresh perspective. And it wasn't just about hiring smart people, it was about fostering a culture of collaboration and intellectual curiosity. At Renaissance Technologies, everyone was encouraged to share their ideas, no matter how crazy they seemed. This open and collaborative environment allowed them to bounce ideas off each other, challenge assumptions, and ultimately come up with more innovative and profitable trading strategies. Chapter 4. Playing Defense Risk Management like Fort Knox. Now, even with the best data, algorithms, and minds in the world, things can still go wrong in the market. That's why risk management was absolutely paramount to Renaissance Technologies' success. They didn't just focus on making money, they were obsessed with not losing it. Their approach to risk management was incredibly disciplined and systematic. They used sophisticated statistical models to assess and mitigate risk across their entire portfolio. Every trade, every position was carefully analyzed to understand its potential downside. They weren't afraid to cut their losses if a trade wasn't going their way. Remember, preserving capital is just as important, if not more important, than making it. They also diversified their portfolio across a wide range of markets and asset classes. This ensured that even if one particular market was experiencing turbulence, their overall portfolio would be protected. This relentless focus on risk management allowed them to weather market storms that sank other funds. It's like they say, don't mistake brains for a bull market. Chapter 5. The learning curve, never stop adapting. The financial markets are constantly evolving, and what worked yesterday might not work tomorrow. That's why Renaissance Technologies embraced a culture of continuous learning and adaptation. They never rested on their laurels, assuming that their past success guaranteed future returns. Instead, they were constantly analyzing their performance, identifying areas for improvement, and tweaking their models. They weren't afraid to experiment with new data sources, new algorithms, and new trading strategies. This constant experimentation allowed them to stay ahead of the curve and adapt to changing market conditions. Simons knew that the moment they stopped learning and adapting, they would start falling behind. In the world of high-frequency trading, standing still is like moving backward. This commitment to continuous improvement is what allowed them to maintain their edge for decades. It's a testament to the power of a growth mindset, even in the cutthroat world of finance. Chapter 6. Cracking the Code. The Power of Statistical Models. Now, let's get a little bit more technical for a moment. At the heart of Renaissance Technologies' success were their sophisticated statistical models. These models were the engines that drove their trading decisions. They used a branch of mathematics called statistical arbitrage, which involves identifying and exploiting pricing discrepancies in the market. These discrepancies might be tiny, often fractions of a penny, but when you're trading billions of dollars, those fractions add up. Their models were incredibly complex, incorporating thousands of variables and data points. They were constantly being refined and updated as new data became available. These models were the secret sauce, the key to unlocking hidden patterns and inefficiencies in the market. They allowed Renaissance Technologies to make incredibly accurate predictions about future price movements. It's a testament to the power of mathematics and statistics in the world of finance. Sometimes the numbers can tell a story that no amount of intuition or gut feeling can match. Chapter 7. The Vault Secrecy and Confidentiality. Now you might be wondering, if these strategies are so great, why isn't everyone doing it? Well, here's the catch: Renaissance Technologies is notoriously secretive about its operations. They operate like a high-tech Fort Knox, guarding their algorithms and trading strategies with extreme secrecy. Employees are required to sign strict confidentiality agreements, and information about their models is tightly controlled. This secrecy is partly for competitive advantage. They don't want their competitors to steal their ideas and erode their edge. But it's also a matter of security. Their algorithms are so powerful, so potentially profitable, that they could be targeted by hackers or even nation-states. By operating in stealth mode, they can protect their intellectual property and ensure the integrity of their operations. This air of mystery only adds to their mystique. They're like the wizards of Wall Street, operating behind a curtain of secrecy and mathematical brilliance. Outrow cracking the code lessons from a market master. So there you have it, the 7 key strategies that helped Jim Simons and Renaissance Technologies achieve those legendary returns. From harnessing the power of data and algorithms to building a world-class team and managing risk like a hawk, they've truly cracked the code of the market. Now, I know what you're thinking. I'm not a math genius, I can't build my own trading algorithms. And you're right, most of us can't replicate what Renaissance Technologies does on that scale, but here's the key takeaway. We can all learn from their data-driven approach, their relentless pursuit of knowledge, and their unwavering focus on risk management. These principles can be applied to our own investment strategies, no matter how big or small. If you want to learn more about Jim Simons, Renaissance Technologies, and the world of quantitative investing, I've included some resources in the description below. And as always, if you enjoyed this video, don't forget to like, comment, and subscribe for more insights on how to build wealth and achieve financial freedom.